Happy Thanksgiving to all our viewers. We're competing with turkey, with stuffing, with the Lions and the Packers, whoever they're playing.
We're going to be talking about Black Friday bargains in the stock market.
This week, I do want to talk about one thing that I bought for the first time ever. It's something that people have mentioned in the comment section on the Wide Moat Show before. It's been on my watch list for a while, but the stock is finally sold off, and I like the entry points.
The riches are in the niches, and I see this value of this very, very beaten down retailer.
Human beings have been in conflict with each other for thousands of years. I think that'll continue to happen.
I think the company, if they move to normal valuation, we're looking at about a 30% annualized total return target. Hello, everyone. It's Brad Thomas, and welcome back to the Wide Moat Show. I'm joined this week with my co-host, Nicholas Ward. And Nick, it's great to see you today.
Yeah, great to see you, Brad. Happy to be here recording I think this video is going to be released on Thanksgiving. So happy Thanksgiving to all our viewers. We're competing with turkey, with stuffing, with the Lions and the Packers, whoever they're playing on Thursday. Going to be any viewers that stop by this video, we really appreciate it because we know that you guys are making a lot of time for us.
Yeah, we just passed a couple episodes ago. We passed the 10,000 subscriber mark. So thank you all for subscribing to the Wide Moat Show. And the last two episodes have done really, really well. We've had a lot of engagement. We've had a lot of comments. And please drop us some comments below because that fuels our continued growth here at the Wide Moat Show. And thank you all for watching here, either on Thanksgiving or on Black Friday. And of course, today's topic, Nick and I, of course, talked in advance. We're going to be talking about Black Friday bargains in the stock market. And so that's what the exciting content that hopefully you all are here for today.
Yeah, we're kind of running out of 52-week low companies. Those last two videos have been great. People seem to love that. We'll have to cycle back to that in a month or two once there's new companies at lows. But I think we're going to talk about 6 companies today. These may not be at lows, but they are companies that Brad and I both like in the market at current valuations today. We'll explain who they are, what they are, why we like them, etc. But before we get into those picks, we do want to tease next week's episode. That's going to be a little bit different. I am not going to be involved. I'm taking a vacation next week. I will be in Disney World when we record on Monday. So instead of figuring out how to get my cell phone working and recording an episode in Epcot, we decided to get me out of there and get me replaced. So Brad, why don't you talk about our special guest for next week, and then I think a lot of viewers will be interested in that.
Well, Nick, do me a favor. When you're down in Disney, and snap the picture of you and Mickey Mouse, because I would love to show the picture here next week, just in remembrance of your not being around for the show next week. So we're looking forward to some pictures.
Yeah, no, we can do that. My wife does a great Goofy impersonation. I wish she was here. We could get her in screen here. So we always have fun talking to the characters because they're wondering where Goofy is, but it's just my wife.
Yeah. So next week, Nick will be in Florida, and I've asked actually a friend of mine who is a former CEO at actually 3 different public companies, Chris Volk. Many of you may be familiar with Chris. Chris, he started a company called Franchise Finance Corp, and he was a REIT. Then he started another one called Spirit, which was eventually sold to Realty Income. And of course, his last public company was Store Capital, ticker STOR. And Chris was, co-founded that particular, they're all net lease REITs, and Chris co-founded Store. What's interesting about Store is Chris and his team convinced Berkshire Hathaway to invest, or maybe Berkshire Hathaway decided to do their own due diligence and invest in Store Capital. So there aren't many REITs, REITs where Berkshire Hathaway has invested in, but Store is one of those. So I'm looking forward to discussing that with Chris next week.
Yeah, it's rare. I watch a lot of financial channels on YouTube, not just ours. And I don't know that I've ever seen anybody interview a guest who's actually made a deal with Warren Buffett. That's coming to the Wide Moat Show next week. So, I look forward to watching that show. I hope you guys do as well. And what's interesting is Chris is no longer a REIT CEO at the moment. I don't know what he's doing, but I've read a lot of his work. He's published things with us at iREIT and at Wide Moat. He's not just a real estate guy. He's a very astute value investor, and he's kind of branched off into other sectors. I've really enjoyed reading his work on, tech stocks or industrials, et cetera. So I don't know what he's going to talk about next week, but whatever it is, it'll be very insightful, and I'm sure we'll learn a lot. So thank you for getting that guest, and I look forward to that video. And with that said, Brad, let's get into our Black Friday picks. Do you want to go first, or do you want me to go first this week?
Let's keep the same routine. It's worked well, so we'll start with you, and then I'll close it out.
All right, so I will go. Probably, I've done my best every week when I think about these things. I don't really want to repeat myself. You guys know what I've been buying. I've been buying BRO, MMC. This last week, I added to my SPGI, my S&P global position. But I've talked about all those things before. So this week, I do want to talk about one thing that I bought for the first time ever. It's something that people have mentioned in the comment section on the Wide Moat Show before. It's been on my watch list for a while, but the stock has finally sold off, and I like the entry point. So I bought shares of MercadoLibre, ticker symbol MELI. It's kind of like the South American version of Amazon. It's a e-commerce platform, and then they don't do a lot of cloud. They don't have like the AWS component that Amazon does, but they do a lot of kind of fintech and like financial, like PayPal type stuff. So they're big into digital payments. They're big into e-commerce. Those are really underpenetrated markets. Brazil, is I think their biggest market, but then they're pretty much all throughout South America. They're the biggest company in South America. So I finally bought shares. I know one of our colleagues that Brad and I used to work with, Adam Gallus at Dividend Kings, he's been a big fan of this company for a long time now. For the longest time, I said, Adam, I don't need to buy MELI when I own Amazon. I don't need kind of the South American Amazon. I have the real Amazon. But my Amazon position's gotten so big now that all these Google, Amazon, Apple, et cetera, the Mag 7 US tech stocks keep climbing. Those positions weightings are already overweight for me. I don't feel comfortable allocating more money towards them. So I finally went with MercadoLibre. And so I'll throw up a fast graph here, as you can see, pull it up on my computer here so I can talk about it. The black line here, the jagged black line, is down to the straight black line. As you can see, this is the cheapest the stock's been in a long time. Obviously, that's always what I'm looking for when I'm buying shares. The company is expensive. It's trading for 48.5 times earnings. That, a lot of people will be turned off by that. But if you look at the earnings growth, they're expected to go up 53% next year. So it's a PEG ratio of less than 1. So a value investor, maybe even like a Chuck Carnival, I'd be interested to hear what he would say about this. A sub 1 PEG is always a great deal. That's what you're looking for. They're expected to go at 34% the next year. They've been growing very consistently for a long time. They just posted their Q3 2025 earnings, and I looked up the stat here. The revenues were up 39%. That marks the 27th consecutive quarter of 30% plus revenue growth. There's not another company in the world that can say that. That's amazing. This company is taking market share in these kind of emerging South American markets. They're giving customers what they want, and that is showing up in the share price growth. We do see MELI has been up quite a bit in the last decade. Their total returns are amazing, and the stock is cheaper because their margins are decreasing. That's the fear here. The revenues continue to rise, but their margins are decreasing. That's what's kind of spooked investors. But that's okay. Like, they're still taking market share. So they're going the Amazon path. They're willing to kind of turn off the profit, nozzle to get market share. And then long term, I think they can turn it back on. So, I've been buying shares here right around 2000, I think right below. I think my cost basis is like 1975. Like I said, 48 times earnings. However, it's not that expensive down the road. 2 years down the road, we're at like 30 times earnings for a company growing at higher than 30%. So this one may require some patience. This is not something that a very conservative investor is probably going to be interested in. There is no dividend. It's very rare for me to take my hard-earned money and allocate that towards a stock that's not going to pay me back immediately. However, like I said, there's no other company growing revenues that consistently at that high of a rate, 30% plus, 27 consecutive quarters. So now I'm in the stock. It's not a large position for me. if I show you guys my top 20 positions, this one's not going to show up. It's towards the bottom of my kind of allocation list. But over time, I think this could grow into a large stake. So I like the valuation here. The stock was at $2,600 not that long ago. Now it's right around 2,000. There you go. So Brad, what do you think? I know Adam followed this. Have you ever looked into this one, or is this not in your wheelhouse?
I am not familiar with that. That's a new name to me, but certainly interesting topic as well. I'm just curious. I've spent a lot of time looking at some real estate deals in Costa Rica. I'm just curious if that app or that technology is available in Costa Rica. So
yeah, I don't know who, because I'd be interested to see. I looked at their map, and it's obviously the South American continent. I'm sure they do. Costa Rica is a smaller market, so I'm not sure how interested they are in that, but it'll be fun to check. So I guess I'll move on to a company that we all have heard of. I don't know if you've heard of MELI. Like I said, dividend investors may not be interested in that stock. It's definitely a growth stock. This one is definitely a boring dividend stock, but I can't believe the yield that we're seeing right now. And I'm talking about Clorox, ticker symbol CLX. You open up the drawer underneath your kitchen sink. I'm sure half the products in there are made by this company. I kind of made a list. What I like about Clorox is they've been divesting kind of non-core brands and really focusing on their top tier brands. I think something like 65% of their revenues come from brands that are either one or two in their category market. That's what I like when we're talking about consumer staples, because there is the idea that private label, generic branded goods are kind of taking away market share from these big consumer staples companies. As millennials and Gen Z and even the younger generations, kind of stop caring about brands. That's not happening here. I'll put up a chart showing the private label penetration into Clorox's kind of the areas of the market they focus on. As you can see, it's been very stable over the last 5 years. So this company is not losing market share to private goods, but the share price is down big because they had a huge run up at COVID. Obviously, we're all buying every ounce of bleach that we could find. That's no longer happening. The company has also divested its vitamin, business. So that is hurting EPS in the short term. However, long term, I think it's a good move. Clorox they own Clorox wipes and bleach, obviously their namesake. They own Pine Sol. They own Liquid Plumber. They own Kingsford Charcoal, Hidden Valley Ranch, Fresh Step, Kitty Litter, Burt's Bees, the lip balm, and Brita filters. Those are like kind of their flagship brands. So I think it's a nice portfolio. It's kind of spread out. You don't need Burt's Bees, but it is a nice luxury. You do need things like Liquid Plumber or Pine Sol, etc. If you have a cat, you need kitty litter. So this company checks all my boxes from a consumer staples brand portfolio standpoint. I like their focus on the number one brands. And it checks my boxes from a valuation standpoint. Here's the fast graph. And as you can see, this stock has plummeted in recent years. During 2020, at the top of the market, where there was kind of the bleach mania, this was a $220 stock. Today, it's trading for right around $100. So it's 50% sell off on a very steady, well-known consumer staple. The yield at the top was less than 2%. The yield today is 4.8%. I think Clorox hit a 5% yield recently on like an intraday dip. I never thought, probably in my life, I would see that type of yield on such a high quality company like this. It just goes to show that, once again, if you're not an AI stock, if you're not exciting, then the sentiment is so poor. But I'm very happy to buy this company. I don't own it. I can't actually own it because of disclosure issues with our newsletters. This is a company that we've talked about in our newsletters. So if you want our in-depth research, you can sign up for the Wide Moat letter at thewidemoatletter.com. Brad and I recently published, 5,000 word research report on this company highlighting our bullish take. But here's kind of the cliff notes. The stock's very cheap, less than 15 times. Like I said, roughly 5% yield. Earnings growth is expected to pick up in the coming years now that the vitamin divestiture has been taken care of. So, when you're trading for 15 times and you have a 5% dividend yield, it doesn't take a lot to get to a 10% annualized return. You pay the 5% yield, you buy back a percent or two worth of shares with your excess cash flows, and you grow your earnings, low single digits. There you go. There's a 10% annualized return. this company over the long term usually averages about 4 to 8% annualized earnings growth. Likewise, low single to mid single digit dividend growth. So very boring, very stable. I like the company at sub 15 times earnings. Its long-term average is 21 and a half times. So if Clorox was to bounce back to that long-term average, we're talking about $150 stock next year. So the stock has fallen 50% from its prior highs. Mean reversion would take it 50% back up to its average. Those are tech stock, high growth type returns on a very boring consumer staple. So Clorox, nobody wants to go out on Black Friday shopping and buy a jug of bleach, but that's what I'm saying we should do here. This company is an easy stock to hold, for the long term. It's been increasing its dividend for decades, and that will continue, throughout the rest of my life, I'm sure. Great
pick here. And of course, great job with the lengthy research report you did for Wide Moat Research. So I encourage all of you who are watching this to sign up for our daily Wide Moat Daily, and that'll get you into our Wide Moat letter. So Nick, I can't wait to hear your third pick, because the first two have been really, really good. So I hope you've closed out with the best.
I'll do my best. Yeah, the third pick is a company I haven't even been following that long, and it recently came onto my radar, and I was very impressed. I like the kind of secular story behind it. Once again, I wouldn't be surprised if anybody has heard of it. It's and I'm sure I'm going to butcher the pronunciation. This company is based in Germany. Never been to Germany. So I don't have that kind of lingo, but it's Rheinmetall. There's two L's at the end. So I think, I think that's how you would say that. This is a defense contractor. It's an industrial company. They have skyrocketed this year. At the end of last year, this was $125 stock. At the moment, it's $350. And I'm looking at an ADR. I'm looking at ticker symbol RNMBY. That's a pretty liquid ADR for American investors. Obviously, if you live in Europe, you can just buy the real shares of this company. They trade for like $2,500. This is like a Berkshire Hathaway type situation where the main shares trade at a much higher than the B shares. But I like this company. It's down. This was a $450 stock not that long ago. So the company has skyrocketed because of the idea that kind of the Donald Trump, the Republican, the kind of America first mindset that we're seeing develop in this country with regard to not entering into foreign wars, pulling back on defense spending. We have a massive deficit and national debt that somehow we need to deal with. One way that you could do it is cutting defense spending. I don't know if either party is going to be on board with that. They talk about it a lot, but they've never done it. If you look at the defense budget, it is a stair-step pattern up and to the right. That's why I own a lot of American defense companies. To me, they're very defensive investments. From a sleep well at night standpoint. Yes, it's tough to kind of profit from war. I pray every night for peace. I hope all the wars across the world end and that we could just like live in harmony with everybody. But the realistic, thing is that's not going to happen. Human beings have been in conflict with each other for thousands of years. The PE here is very high. It's 53 times. I don't know where the fair value here is expected to lie. Earnings are up 82% this year, and they're expected to compound at 50% moving forward because of that America First idea. This company is located in Germany. Europeans are starting to realize, hey, we may not be able to count on America for all of our defense needs moving forward. Trump has asked them to increase their defense spending as a portion of their GDP. But the Ukraine situation has created a lot of doubt with regard to how reliable of a partner is America in a war that America is not all that interested in. So they're looking to kind of self-fund their war efforts in Europe, and this company will be a major player here. They do land-based, they do tanks, jeeps, supply trucks, ammunition, rockets, etc. Most of the types of things you need in a war, this company produces. Their earnings are skyrocketing because of demand. The stock has sold off recently because of the idea that maybe the Ukraine and Russian war is going to end soon. Trump is trying to work on these peace talks. I don't know where those are going to go, but when the war ends, obviously demand in the short term will sink, but there's a lot of rearmament that needs to happen across Europe. And, if you read kind of military reports, there's thoughts that in just a few years, Russia could be ready for another kind of, westward invasion. So I think that there's going to be a lot of just defense spending in Europe over the next decade or so. This company is going to be a major beneficiary. I regret not hopping onto this train sooner. In hindsight, that's such an obvious thing, right? Like, obviously, Europeans are going to look to self-fund this stuff. Where's it going to come from? This was, a year ago, I should have bought this company. I feel bad that I didn't buy it now, but the company's down, I think, about 25% from the highs. It's down another 4% today. There's a lot of really negative sentiment on these shares at the moment. So I'm tracking them closely. And as this company continues to fall, don't be surprised if you hear that I buy it. It has been paying a growing dividend for about, I think, 7 or 8 years now. The yield's pretty low at, 0.5%, but it's growing at, a decent pace, double-digit dividend growth. And I expect that to continue with this massive EPS growth. So Rheinmetall, AG, ticker symbol RNMBY. That is a interesting thing, I think, for American investors to take a look at. It's probably a company you're not familiar with. We all know Lockheed Martin. We all know Raytheon. We all know General Dynamics, et cetera. I think this is a name that should go into that kind of defense bucket, for European defense in particular. So those are my 3 picks today. Names we've never discussed on this channel. So hopefully they provide interesting research ideas for our viewers.
Great job, Nick. Great picks. I'm going to keep moving, try to keep this thing on track. I've got 3 picks. Now, many of you know, I was a shopping center developer and retail developer before I became a Wall Street writer. And so I love retail. My daughter ended up going to work for CNBC and spent 3 years at CNBC covering retail. She's at the Wall Street Journal now. But I've always had a passion for retail, and that's frankly just rooted in the fact that I have 5 kids and 4 daughters. And so they love to shop. So a lot of these next 2 picks are going to be familiar names that familiar to me because I see the credit card statements. Most recently, I saw the credit card statement and Lululemon Athletica, and I'm going to pronounce it Lululemon. I'm sorry if I butchered this name. But Lululemon is what we say, I guess, here in the South. Company has really sold off drastically. I'll show you a fast graph here in just a few minutes. Even last week, the company's president of the Americas division, Celeste Bourgeon, may have butchered that name too, said she was leaving to go to work for Vail Resorts. She had been at Lululemon for about 19 years. So again, that's a kind of maybe a red flag, but also, this is not the first. This is actually the second of a high-profile exit with the company in the last 18 months. There's Chief Product Officer's son, Show, who also left. So share prices, again, have really been weak, especially for a lot of retail stocks have fallen off. But Lululemon is a Canadian retailer, and they've been trying to invigorate this brand. They've got obviously some management changes. Even more recently, in the last several weeks, they announced a partnership with the NFL, covering all 32 teams within those stores. There's about 750 online stores. And of course, Lululemon's done a great job addressing the omni-channel, the omni ecosystem. So they've spent a lot of time on their technology and their social media. Now, around October the 10th, the founder and the former CEO of the company, a guy named Chip Wilson, he actually bought a full-page ad in the Wall Street Journal that was just a targeting, almost like an activist of such, targeting Lululemon. And he said they have dismantled the business, referring to Lululemon. He said they've dismantled the business model, lost employees who held the institutional knowledge that made the company great. So obviously he's been a big critic of the company, really focused on the fact the company is not focusing on product innovation enough, and they've just been focusing more on short-term financial gains versus quarterly reports. Now, in 2024, the company had net revenue increases of 14%, e-commerce net revenue increases of 6%. However, after reporting the second quarter earnings, they revised guidance downward from 5 to 7% to 2 to 4%. And of course, the stock price plunged as well on that day. For that same quarter, they reported revenue of $2.5 billion and earnings per share of $3.1 billion. Full year guidance forecast to be in the range of $2.8 billion to $11 billion, representing just modest growth of 2% to 4% relative to 2024. Now, earnings per share guidance was lowered as well. We'll show you that here in just a minute on Fast Graphs. They've also been, their balance sheet, by the way, is in really good shape. That's one of the reasons I picked this company. They had about $1.16 billion in cash and cash equivalents and absolutely zero debt on the balance sheet. They've also been aggressively buying back the stock. In the latest quarter, they bought 1.13 million shares, an average price of $247. And they have approximately $860 million remaining on their $1 billion repurchase program. Now, we'd like to talk about Moats here at Wide Moat Research. There's an analyst on Seeking Alpha who pointed out that since 2010, Lululemon's return on equity has fluctuated between 20% and 30%. While there's clear wide fluctuation in return on equity, ROE, there's no doubt that Lululemon is doing something phenomenal as it allows the company to generate a high return on equity, but also to maintain it. I actually put a chart here from this Seeking Alpha author, and you can see they've had consistent ROE for multiple years, which is indicative of this wide moat the company has. They've been able to maintain that return of capital for this extended period of time. And of course, that's been able to allow them to fend off the competition. Now, in terms of valuation, again, shares, I'm pulling up Fast Graphs here. Shares are a bargain, trading at $168.18 per share. Again, that's as of today, not when this is recorded or published on Thursday. The PE multiple is 12.7 times compared with their normal valuation. You can see here in Fast Graphs at 37 times. You can see I put a red line here showing that very wide margin of safety that exists between their current valuation, their normal valuation. I also like to consider their peers like Nike and Under Armour. They are both trading about 31 times currently. So again, really much cheaper. Now, but when you compare Nike and Under Armour, it's also important to compare kind of the influencers of those two iconic brands. I mean, you have people that everybody recognizes. Carmelo Anthony, of course I do, as a former basketball player. Tiger Woods and LeBron James. Those are all underneath the Nike brand. And Lululemon focuses more of this ambassador program. These are like traditional and not really traditional endorsements that most people are familiar with in terms of celebrities or these elite athletes. Lululemon focuses more on these local influencers and actually yoga instructors are a big part of their ambassador community. So I've said this many, many times on other YouTube shows. You know, the riches are in the niches. And I see this value of this very, very beaten down retailer. If you look at the next chart, looking back at the historical performance, you can see many years in which the company has had very high earnings per share. I've highlighted all of those years. So, you know, you can look at the 2011, 106%, 2012, 50%. This is earnings per share growth. 2013, 46%, 2017, 15%, 2018, 21%, 2019, 48%, 2020, 28%. Now, coming out of COVID in 2022, 66%, and 2023, 29%. Fiscal year 2024, 27%. Now, again, shares are down, but not as, you know, it's crazy because their earnings per share decline is very modest. You can see they're only down about 12% based on that's their fiscal year of 25, and based on analyst consensus, we're only looking at very modest growth of about 2% next year, followed by return to normal growth or positive growth of 6% the following year. So the shares are beaten down a lot. They haven't pulled back. The earnings haven't pulled back. So this is where I think that bargain remains. So I don't think the multiple will go back to 39 times anytime soon. But I put together this fast graph chart showing 30 times, which I think is a very reasonable multiple. And that translates into a 50% annualized return. No guarantee of that, but given what I'm seeing, again, the quality of this business model is a niche product they offer, but they've done a really good job with that. So anyway, that's Lululemon. I'm going to move on to the next pick. Everybody's familiar with Target. Target shares have fallen off by 36% this year. Now, we've covered Target, obviously, at Wide Moat for quite some time. And I've mentioned in the past the real estate angle here. I'm going to just reference this really quickly. Target operates about 1,989 stores in the U.S. with 66 supply chain facilities. Around 75% of the U.S. population lives within 10 miles of a Target store. So they're scattered all over the U.S. in very strategic markets. I think they do a really good job selecting real estate, and that's speaking from a real estate developer of over 20 years. Now, within those assets that I mentioned, those properties, they actually own 1,538 of these. They're on the balance sheet. They own these properties. They lease another 280, and they ground lease another 160. So if they need capital, they can certainly go to their closest piggy bank, which is their balance sheet, and do some sell leasebacks with companies like Realty Income that I've talked about almost weekly, that is a net lease landlord that has a very attractive cost of capital advantage. And there's a good reason that I think Target is going to need some money. They've actually mentioned on the latest earnings call that they plan to invest another $1 billion next year to improve the stores, which brings their total investment to $5 billion. Now, what they're going to do with this capital is improve the merchandise selection, the digital capabilities, obviously utilizing more technology to generate more sales. The incoming CEO, Michael Fedelke, and I may have butchered that name too. Sorry, Michael, but he is the incoming CEO. He said that, quote, the mission 1 through mission 2 is to get back to growth for the company. So obviously, he's very much interested in getting this company back to kind of more sound footing. The company also said the additional spending is necessary after Target reported its 12th consecutive quarter of weak or falling sales. Now, net sales fell 1.5% in the most recent quarter to $25.3 billion compared to last year. Net income fell 19% to $689 million. They also lowered expected profit ranges for the full year to between $7 and $8 a share, down from $7 to $9 a share, primarily due to this current volatility. Now, the interim CEO, or soon upcoming CEO, said consumers continue to spend cautiously on discretionary items like home decor and apparel. And yet the most recent quarter was volatile because of several external factors, such as the pause in that SNAP funding, as well as the government shutdown. So the company's got an extremely good balance sheet. Again, they've got the real estate if they need it, but they're an A-rated company. Again, we've written about the company quite a bit. I really think what I admire this company for is the fact that they have really been a terrific capital allocator, as evidenced by their dividend history. This company has become a dividend king, so they have increased that dividend for over 50 years in a row. Also, they look to deploy any excess capital to share repurchases, which obviously is very cheap right now. They deployed over $150 million to repurchase shares in the third quarter, and after purchasing no shares in the second quarter. They've also announced some job cuts. They're cutting around 11,800 corporate jobs, 8% of employees. Again, that's part of this new strategy with this new CEO. Now, I'm going to show you this fast graph here again. Really good indication of where I think the value is. First of all, you can see shares are trading at 11.6 times. That's a substantial discount to that normal 16.5 times multiple. The dividend yield is now a very juicy 5.2% with a rock solid payout ratio of 50%. So obviously they're going to keep increasing that dividend over time. As you can see with this fast graph, though, they have historically generated very steady earnings with the exceptions of just a couple years. First off, in 2009, obviously was coming out of the Great Recession, earnings fell 14%. Then move over to 2014, they saw a 27% decline in earnings per share, but rebounded to 33% the following year. In 2018, EPS declined by 6%. In 2023, it dropped by 56%. And in fiscal 2026, the company EPS is expected to decline by 18%, based again on weaker discretionary spending and external factors. I'm actually writing on some of that later today in the Wide Moat Daily. That'll come out later this week. Consensus growth looks very promising, though, of 7% 2027 and 8% in 2028. So the key here is to be patient. Now, as the incoming CEO explained on the latest call, quote, "We are taking bold, decisive steps to reshape how we work and reignite growth with urgency, focus, and confidence in who we are and who we can be. We know what makes Target special: an unmatched merchandising authority and the ability to create joy through an elevated and inspiring guest experience, all enabled by the power of technology to amplify both speed and connection across every part of that business." Now, when you look at this new CEO, again, Mr. Fidelki, obviously the market didn't react very favorably, but I did some checking on him, and he's going to take over the reins, I think, February of 2026. However, he actually joined Target in 2003. That's over 22 years ago, and he started out as an intern, and he's held about every position except for maybe the janitor. He's been in leadership positions, some finance positions, merchandising, human resource, and operations. So I think he's going to really turn this thing around, and I'm really betting on Target. I think that based on the current price point, I think the company, if they move to normal valuation, we're looking at about a 30% annualized total return target. So, Nick, I'm going to cut this short here today. We're at 35 minutes. I was going to throw a retail read in here, but I'll also respect our audience here, who hopefully is going to be finishing either eating turkey or getting ready to eat turkey, or actually do some Black Friday shopping. So we're going to end it here. And Nick, I want to also wish you well next week for your travels. Again, we'll be looking for the Mickey Mouse photos. We're really expecting these, and we're looking forward to a well-deserved week off for you as well and your family.
Well, I appreciate that. And cutting it short, I think, is okay. This video, just listening, there's going to be something for everybody. You either, if you like war, you like Rheinmetall. If you like peace, you're probably into yoga with Lulu. If you like fast-growing retail, you like MercadoLibre. If you like a value retail play, you like Target. So I think we've covered all of our bases here. 5 high-quality stocks that we discussed, not 6. So sorry about the misleading comment in the beginning, but I wish you all a happy Thanksgiving. Enjoy time with your family, with your loved ones. Enjoy your turkey, enjoy your football, etc. And I guess Brad will see you next week. I'll throw up some pictures from Disney World. I'll send those to him on Slack, and he can include them in the video. And then I'll see you guys in 2 weeks. Sleep well at night in between now and then.
Have a great week. Hi, everyone. Thank you for watching today's episode of the Wide Moat Show. Please comment, like, and subscribe below, or go visit us at widemoatdaily.com. As always, happy swan, sleep well at night investing.